Europe has just crossed a line that most governments have debated for decades but hesitated to touch. For the first time, a European country has moved forward with a tax on unrealized gains, meaning wealth that exists on paper, not from assets that have actually been sold. This is not a small technical adjustment. It represents a philosophical shift in how governments view wealth, ownership, and taxation. To understand why this matters, you first need to understand how capital gains taxation traditionally works. Under normal systems, gains are taxed when they are realized. If you buy a stock at 100 and sell it at 150, you pay tax on the 50 profit. If you never sell, there is no taxable event. The gain may exist on paper, but it is not considered income yet. That framework has shaped investment behavior for generations. It encourages long-term holding. It allows capital to compound. It prevents forced liquidation simply to satisfy tax obligations. An unrealized gains tax changes that structure entirely. Instead of taxing profit when it is sold, the government taxes appreciation while you still hold the asset. That means investors could owe taxes even if they have not received any cash. And that changes incentives dramatically. Why would Europe move in this direction? The answer lies in fiscal pressure. Across advanced economies, debt levels have risen sharply over the past decade. Pandemic spending, energy subsidies, defense commitments, and entitlement obligations have expanded government balance sheets. At the same time, political resistance to broad tax increases remains high. Governments are searching for revenue without imposing visible, across-the-board tax hikes on middle-income voters. Large asset holders become the focus. Wealth inequality has widened across many European countries. Asset owners benefited significantly from years of low interest rates and rising equity markets. Real estate prices climbed, stock valuations surged, financial assets appreciated dramatically. From a policy perspective, those gains look taxable. The political argument is simple. If wealth increases in value, even without a sale, it represents economic power that can contribute to public finances. But the economic implications are far more complex. An unrealized gains tax effectively forces liquidity decisions. If you owe tax on appreciation but have not sold the asset, you must find cash somewhere else to pay the bill. That may mean selling part of the asset. It may mean borrowing against it. It may mean reallocating capital into more liquid structures. Over time, this can reduce long-term holding incentives. One of the foundations of stable capital markets is deferred taxation. Investors are willing to hold productive assets because they are not penalized annually for appreciation. That patience supports corporate growth and innovation funding. When taxation becomes annual and mark-to-market, behavior shifts. Investors become more cautious about volatile assets. Entrepreneurs may reconsider equity-heavy compensation. Family businesses may face recurring valuation challenges. Real estate investors could encounter cyclical tax spikes during price surges. This is why unrealized gains taxation has historically been controversial. There are also valuation questions. Publicly traded stocks have daily market prices. But what about private companies? What about illiquid real estate? What about art venture investments or complex ownership structures? Annual valuation introduces administrative complexity and potential disputes. Governments must determine fair market value each year. Asset holders may contest those valuations. Compliance costs increase. Enforcement becomes technically demanding. Supporters argue that modern financial systems already track asset values digitally. They claim large wealth holders can manage periodic mark-to-market taxation. They frame it as closing a loophole where long-term appreciation escapes taxation indefinitely. Critics argue it creates instability. If markets fall sharply after a year of taxation on paper gains, investors may have paid taxes on wealth that later evaporates. Some systems attempt to address this with loss offsets, but volatility complicates revenue predictability. Beyond mechanics, the larger issue is signal. When a government moves to tax unrealized gains, it signals a shift in how property rights and capital are treated. It suggests that holding appreciated assets is no longer a passive state but a taxable condition. Markets react not only to rates, but to precedent. If one European country successfully implements such a system, others may evaluate similar approaches. Policymakers globally watch each other closely. Fiscal experimentation spreads faster in periods of debt strain. This matters for capital mobility. Europe operates within an integrated economic zone, but capital remains globally mobile. If taxation frameworks diverge significantly between regions, wealth may migrate. High net worth individuals and investment firms consider tax stability when deciding residency and capital allocation. An unrealized gains tax introduces a new variable into that calculation. Supporters counter that sophisticated anti-avoidance frameworks can limit migration. They argue that global cooperation on taxation has increased in recent years. They suggest that mobility risks are overstated. Still, capital historically responds to incentives. Another dimension is behavioral. If investors expect annual taxation on appreciation, they may shift portfolios toward lower volatility assets. They may prefer income-generating assets over growth assets. They may structure holdings differently to reduce mark-to-market exposure. Over time, this can subtly change capital formation patterns. Growth-oriented sectors that rely on long-term equity appreciation could see adjustments in investor appetite. Venture capital dynamics could evolve. Startup valuation cycles could become more cautious. This is not necessarily catastrophic, but it is structurally different. The move also intersects with broader debates about wealth taxation. Traditional wealth taxes target net worth directly, often annually. Unrealized gains taxes focus on appreciation rather than total asset value. The distinction matters legally and economically, but politically the message overlaps. Accumulated capital is being asked to contribute more. Whether this becomes a one-country experiment or a broader European trend remains uncertain. What is clear is that fiscal pressure is intensifying across advanced economies. Aging populations, high debt burdens, and slower structural growth make revenue expansion attractive. When broad-based tax increases are politically difficult, targeted capital measures gain attention. Markets now face a new question. Is this an isolated adjustment or the beginning of a new tax paradigm? If the policy remains limited in scope, carefully designed, and focused narrowly on ultra-high net worth individuals, its systemic impact may be contained. If it expands gradually, its influence could reshape investment behavior over time. For now, the significance lies in precedent. Europe has crossed into territory long debated but rarely implemented at scale. That decision reflects deeper forces: fiscal strain, inequality concerns, political recalibration, and shifting views on capital ownership. The immediate effects may be modest, but the long-term implications depend on whether this becomes an exception or a template. When tax policy evolves, markets adjust. When markets adjust, capital flows respond. And when capital flows respond, economic structure gradually shifts. This is not just about one new tax. It is about the direction of fiscal strategy in a high-debt world. And that direction may matter more than the rate itself. The real significance of an unrealized gains tax is not the headline. It is the second-order effects. Tax policy rarely changes markets overnight. What it changes first is incentives. And incentives shape behavior long before outcomes become visible in economic data. When appreciation becomes taxable annually, capital allocation decisions begin to shift. Investors who once prioritized long-term growth may begin calculating short-term liquidity needs. Holding an asset purely for compounding becomes less attractive if appreciation triggers recurring obligations. The psychological shift alone can influence portfolio construction. Over time, growth capital may become more selective. Entrepreneurs often build companies without realizing gains for years. Founders hold equity that appreciates dramatically on paper but generates no cash flow. Under a traditional system, taxation waits until exit. Under a mark-to-market framework, paper success can generate real tax liability. That introduces friction. It may encourage earlier liquidity events. It may push founders toward structured payouts. It may alter how private equity and venture capital funds structure ownership. Subtle shifts like these accumulate over time. There is also the volatility problem. Markets rise and fall. If gains are taxed during a bull cycle and prices later decline, investors may have paid taxes on wealth that no longer exists. Even if systems allow future loss offsets, timing mismatches create cash flow stress. Governments can attempt smoothing mechanisms. They can average valuations across periods. They can apply thresholds that target only very high net worth individuals. But complexity increases with each adjustment. Complex systems create compliance burdens. Valuing publicly traded stocks is straightforward. Valuing private companies is not. Annual mark-to-market assessments for illiquid assets invite disputes, appeals, and negotiation. Administrative infrastructure must expand to handle that complexity. Supporters argue that modern financial transparency makes this manageable. Critics argue that administrative costs may erode expected revenue. But beyond mechanics lies a broader macroeconomic issue. Capital is mobile. Europe operates within a unified economic area, but wealth is not geographically static. High-net-worth individuals often hold global portfolios. Residency decisions increasingly consider tax stability, predictability, and long-term planning security. If unrealized gains taxation remains limited to one country, capital could shift within Europe. If it spreads regionally, the calculus changes. If it expands globally, mobility constraints narrow. This is why precedent matters. Tax policy innovations rarely remain isolated experiments. Policymakers in other jurisdictions observe outcomes closely. If revenue flows stabilize without triggering capital flight, similar proposals gain momentum elsewhere. In high-debt environments, governments search for politically feasible revenue sources. Broad-based tax hikes are visible and unpopular. Targeted wealth measures appear more concentrated and politically viable. That makes unrealized gains taxation appealing in theory, but markets price risk through expectations. If investors begin believing that mark-to-market taxation will spread, behavior adjusts preemptively. Asset location decisions shift. Portfolio strategies evolve. Corporate structures adapt. Even without immediate policy expansion, anticipation influences capital flow. There is also the investment cycle dimension. Modern economies rely heavily on capital markets to fund innovation. Equity markets finance growth sectors, technology development, and entrepreneurship. When taxation frameworks change materially, risk appetite may recalibrate. Some investors may prefer income-generating bonds over growth equities. Others may shift toward jurisdictions perceived as tax stable. Venture capital models could evolve to accommodate recurring taxation risk. This does not imply economic collapse. It implies structural recalibration. Another important factor is revenue stability. Unrealized gains taxes depend heavily on market performance. In bull markets, revenue surges. In bear markets, revenue collapses or turns negative through loss offsets. That volatility makes budgeting unpredictable. Governments often prefer stable revenue streams. Consumption taxes, payroll taxes, and income taxes offer more consistent projections. A tax tied directly to asset price fluctuations introduces fiscal cyclicality. If markets decline sharply after a year of strong gains, governments may face revenue gaps just as economic conditions weaken. This creates policy dilemmas. Should rates be adjusted during downturns? Should payments be deferred? Each adjustment complicates the framework further. The philosophical shift is equally important. Traditionally, taxation has focused on realized income, wages, business profits, dividends, capital gains at sale. Unrealized gains taxation moves closer to taxing balance sheet changes rather than cash flows. This redefines how ownership is treated. Supporters argue that wealth accumulation without realization can lock in inequality indefinitely. They contend that mark-to-market taxation prevents indefinite deferral strategies and ensures that extreme asset growth contributes to public goods. Critics argue that taxing paper gains undermines long-term capital formation and introduces instability into investment planning. Both arguments reflect different priorities, equity versus efficiency. The broader macro context cannot be ignored. Advanced economies face rising debt burdens. Aging populations strain public finances. Growth rates have moderated compared to earlier decades. In that environment, governments explore structural tax changes rather than marginal rate adjustments. Unrealized gains taxation fits into that category. It is not simply about revenue. It signals a willingness to reconsider foundational financial norms. Markets tend to tolerate higher rates more easily than structural uncertainty. A predictable tax regime allows planning. A regime perceived as fluid or experimental increases caution. If this policy remains narrow, targeting only ultra-high net worth individuals with carefully designed thresholds, its macro impact may remain contained. If thresholds expand gradually, its influence widens. There is also a political economy angle. Wealth taxation debates intensify during periods of inequality visibility. Asset inflation over the past decade disproportionately benefited those with capital exposure. Policymakers respond to social pressure for redistribution. Yet redistribution mechanisms interact with growth incentives. Balancing fairness and dynamism is historically difficult. This is why the global response to Europe's move will matter as much as the policy itself. If markets absorb the change calmly, policymakers elsewhere may gain confidence. If capital outflows accelerate or investment slows materially, expansion enthusiasm may cool. In the short term, markets will likely analyze implementation details rather than panic. Scope matters. Exemptions matter, thresholds matter, enforcement clarity matters. In the long term, the deeper question is direction. Are advanced economies entering an era of structural wealth taxation to address fiscal strain? Or is this a limited experiment responding to specific national conditions? Tax regimes shape economic behavior gradually. Over decades, small structural changes accumulate into measurable differences in investment, entrepreneurship, and capital mobility. Europe's move does not guarantee a global shift, but it opens the door. And in fiscal policy, once a door opens, it rarely closes quietly. The next few years will reveal whether this remains symbolic or becomes structural. For now, one thing is clear. The debate has moved from theory to implementation. And once implementation begins, the financial world adjusts accordingly.